Fractional reserve banking has been practically dead for a while now, but officially deceased March 15th, 2020, when the Fed announced that reserve requirements for all member banks would be set to zero. But this isn't a soliloquy on the necessities of reserve requirements, but on something much more real and pressing in the months to come. That would be the federal funds rate, which was once an integral part of the fractional reserve system. It has since been hijacked into another giveaway for the rich. Today, the Fed rate is no more or less than the interest paid to banks on balances held at the Federal Reserve through what is called unshockingly interest on reserve balances, or IORB. The Fed rate is money paid to banks in exchange for not loaning out your money. And looking at what the Fed needed to do the last time we experienced inflation at this level, if the Fed actually chose to move against inflation in a meaningful way, it will likely be paying the banks trillions of dollars to do it. But don't call it a subsidy. And by the way, a monetary device that traditionally was used to restrict the creation of money now actually creates money. Smart move, my dudes. As I hinted at earlier, abolishing reserve requirements predates the March 2020 announcement. Through accounts known as swaps, for decades now, larger banks had been using a loophole to get around being constrained by reserves. This is how the idea of paying IORB first came about, because why force banks to not lend out money when you could just pay them to do it instead? The change in March of 2020 really only mattered to smaller banks if it mattered at all. IORB was already being planned before the 2008 financial crisis, but it wasn't until the crash in quantitative easing began that it was implemented. Not a coincidence. In a 2016 article attempting to defend the policy, Ben Bernanke writes, quote, "Without the ability to pay interest to banks, the Fed would likely have to implement any tightening of monetary policy by rapidly selling assets it holds. This would have difficult to predict effects and would likely prove highly disruptive to financial markets, to say the least." The problem is Bernanke is a true believer, so he doesn't realize when he's saying the quiet part out loud. Protecting financial markets is priority one. So fixing swaps and restoring reserve requirements would mean that raising the Fed rate once again would involve the Fed selling bonds in order to reduce excess reserves, which once QE started would mean releasing the pressure it's keeping on the treasury market, which to Bernanke was totally apparently unacceptable. And you can't very well be selling bonds while you're buying bonds. And this is a good place to mention the reverse repo market. And I'm trying to paint in broad strokes. So the only thing I will say about it is that the Fed has extended the IORB rate, well, a few points lower than it, to any financial institution who can muster the minimum $1 million bid for what are called repurchase agreements. So when that windfall will come, it won't be restricted to just member banks, but other financial institutions as well. All right, let's do some math. So in 2021, the average IORB was 0.125%. And the IORB that they paid at year end ended up 5.4 billion. An additional 0.44 billion was paid via the repo market to other financial institutions, for a total of 5.8 billion. If IORB was 10%, how much would be paid out to the banks in 2020 something? So the IORB, which is 405 billion, paid in interest for the banks doing nothing for something that we used to not pay them for, but force them to do it. Okay. Now the repo, they only started doing the repo in September, and that was kind of this is a bit of an estimate. I'm just scaling it out. If they were doing it for the whole year, this wouldn't be 0.44 billion. So anyway, so you might assume that if the IORB is 10%, then these numbers would even be higher than what we're looking at now, because right now, because the interest rate was 0.125, the money was anywhere else that it could be making more than that. The repo is 88 billion. I'm really not sure how high that could go. Reserves amount with IORB at 0.125. If that IORB was 10% instead, we would be looking at $500 billion. But we should expect that to be higher. I just don't know how much higher. It's really this number that could get out of hand pretty quick. So the Fed wanted a way to slow down the economy in case it overheated without directly affecting the amount of money in financial markets. And if some banks got paid a bit of money in the process, whatever, good times. But by separating the Fed rate from bond transactions, they ironically created a method for reducing the money supply with mitigated effects on the actual economy, though the whole point of separating them was not to have to sell the bonds. In Bernanke's article, he worries the Fed writing checks to banks might create a perception problem, though it appears he worried for not, as barely anyone took notice, though partially, in my opinion, by design. I mean, this Investopedia page, for instance, the Fed funds rate does not at all even mention the IORB despite being updated 15 days before the recording of this video, 13 years after IORB was instituted. It does mention reserve requirements a few times. Inflation was solved in the early 80s with double digit Fed rates. It was solved by limiting banks' ability to create money. It also slowed the economy down in the process, but when dealing with stagflation, lowering the money supply is the much more important part of raising the Fed because the economy was never overheated in the first place. And therein lies the problem. The monetary device meant to restrict the creation of money has been perverted into just another method to create it. For further videos on this topic and to support independent investigative journalism, please consider subscribing.